The opposition comes down to putting property rights at the forefront of the legislation.
In New Zealand, he was bankrupted in 2009 with debts of more than $200 million, but that hasn't stopped him from living in a luxury apartment overlooking Sydney Harbour.
Having become aware of that issue, what the employer would typically be expected to do is investigate the circumstances of the assault.
Really, there's quite a lot of divergence across the Tasman. We've been sort of talking about trans-Tasman divergence because the RBNZ did take a different approach to the RBA.
The other one is more aimed at startups because they're still in loss mode, so they can get refunded their tax losses.
Welcome to the Weekly Wrap, where we go over the top video stories from the past week. First up, what happens when a former Kiwi bankrupt and an Aussie crime kingpin cross paths? Nothing good, as NBR's Australian correspondent Lachlan Colquhoun investigates from Sydney.
Mark Bryers is a name many Kiwis would remember from his role in the collapse of property investment company Blue Chip about 15 years ago. Some 2,000 investors lost a collective $84 million in that disaster, but Bryers was spared jail time. He fled New Zealand and moved to Australia. Bryers' Australian career, however, is likely to end in some jail time. He is facing a maximum of 25 years in jail after being found guilty recently over an $18 million tax scam. NBR's Sydney correspondent Lachlan Colquhoun has been following the case and is writing about it in his Underarm column this week. Lachlan, tell us a bit about Bryers' life in Australia after Blue Chip.
Yeah, Hamish, he's apparently been living in Australia since 2006, and that predates the Blue Chip collapse. He's been using variously the name Mark Ryan, apparently, in Australia to escape his past. Of course, in New Zealand, he was bankrupted in 2009 with debts of more than $200 million, but that hasn't stopped him from living in a luxury apartment overlooking Sydney Harbour. So he started a company in Australia called Talos, and that had the same trajectory as Blue Chip, and it collapsed in 2015, owing creditors around 7.5 million Australian dollars. And the next thing we know is that he popped up in 2018 as a collaborator and associate of a guy called George Alex, who's a fairly notorious figure in Australia. He ran a labour hire business, and Alex was pinned in a Royal Commission in 2015 for bribing union officials to get jobs on big construction sites, and he became Bryers' associate in Australia.
So what were the charges against Bryers specifically in this tax scam case?
Okay, so this is a separate case after a lot of investigation by the Australian Federal Police. Alex and Bryers were running a payroll scam, and they were charged with a group of others defrauding the government of around 18 million New Zealand dollars. So the way that they ran it was they created a payroll company into which the salaries of workers were paid, and they withheld the tax owing to the government and the superannuation benefits, and they paid the workers but kept the rest of the money. So they operated with third companies. So the money would go into the main company and then would be siphoned off into another third company with a straw director fronted by fairly random people who had absolutely no idea of what was going on, and they were just paid cash to front these companies. And then Bryers and Alex and their associates would siphon this money off, and then they would phoenix the companies. They would send them into bankruptcy, close them down, liquidate them with all their debts, and then start up another company and go through the whole process again. So his share of all this scam was apparently 1.9 million Australian dollars.
So what was his role in the scam as well?
Well, Bryers would seem to be the one who upscaled it almost into like a franchise arrangement. And the police sort of got onto this quite early, and there was many hours of phone conversations between the conspirators. In one, there's a phone tap in which Bryers is telling Alex about a cunning plan to create a network of third-party companies where the money could be siphoned off. And by 2019, they had 10 companies in this structure, which they believed could get them around 5 million Australian dollars per year. And this all came crashing down. The authorities were onto them pretty early. One of them was audited, and all of a sudden they got a tax bill for 4 million Australian dollars from the tax office, and they realised that the game was up.
So this case, I think, first surfaced quite a few years ago. That the actual 6-month-ish High Court trial delayed multiple times, 6 months in court. What happens to Bryers now that he's finally been found guilty after all of that?
Yeah, so Bryers was and four other people were found guilty after it was a jury trial, which surprised me. I would have thought that that it would have been a judge-only trial given the complexity of the evidence. But the jury found five of them, including Bryers, guilty after, as you say, a 6-month trial. They took more than a month to deliberate before coming back with the verdict of guilty. He faces a maximum of 25 years in jail. And in comparison, there was another payroll scam recently involving a company called Plutus Payroll, involving the son of a senior official of the Australian Tax Office. He's currently serving 15 years in jail. So that could give you some kind of comparison as to what Bryers might be facing. Although the numbers in Plutus were higher than in this one, but. That gives you an example of how the courts will look at this. So he'll be sentenced in November. He's currently out on bail. So it would seem his sojourn in Australia will continue for some time to come. So you won't see him back in New Zealand in a hurry. And there's probably quite a few Kiwis who'll be happy about that.
And Lachlan will be back with another Underarm column next week. Well, hopes of some sort of consensus on the reform of the Resource Management Act have all but disappeared, as political editor Brent Edwards explains. The coalition government has unveiled its plan for reforming the RMA, but it faces strong political opposition. Well, let's bring in NBR's political editor Brent Edwards. So, Brent, what is the government proposing?
Well, it's essentially proposing, and this is the final reform of the RMA, because, it's been doing these sort of interim things like the fast track approvals bill and the like, but it's proposing two pieces of legislation to replace the RMA. And one basically will be to enable development for infrastructure, housing and the like, and the other will deal separately with the environmental effects of that. And of course, and a big part of the legislation is that it's going to put property rights at the sort of forefront. So, and one of the main consequences of that will be, for instance, that it will restrict who can object to a development. So basically, you'll only really be able to object if you are directly affected by that development. You can't just object because you don't like it because of whatever consequence you might think it'll have.
Why the opposition?
Well, the opposition comes down to putting property rights at the forefront of the legislation, and a belief that I guess environmentalists but also the opposition parties have, that means the environment will be downgraded, that your property right will go ahead of the environment. So whatever you want to do in your property will be all fine, even if you are, kind of stuffing up the environment. Now, the government argues, and the Parliamentary Under Secretary Simon Court, who's kind of pushed a lot of this, argues very much, but they're also giving the environment a property right, and therefore it's got a right. And so they're arguing the environment will be protected and that the legislation will allow more development to go ahead, but at the same time offer stronger protection to the environment than we've seen under the RMA. And everyone does agree is that the RMA has not done a good job at either allowing development to go ahead or at protecting the environment.
Will this replacement legislation last a long time?
Well, that is going to be the big question because, since the RMA came into effect in 1991, it's been fiddled with constantly. And so it's grown and grown and grown. And that's one of the things really that's led to a piece of legislation that hasn't been fit for purpose. You then obviously had the previous Labor-led government go through a long-winded process of reform and coming up with its two pieces of legislation, which had only passed into law before the election. Obviously, you got to change the government, and one of the first things the coalition government did was scrap that. So what are the chances then, when we next have a change of government, that what National puts into effect, if it's not supported by Labor and the Greens, then gets changed again? So that's certainly a big possibility. The difficulty of getting real consensus around those planning laws is a real problem. And if they can't find some consensus, and you could keep on having this sort of toing and froing between legislation which some say is more pro-development and then legislation which others would argue is more pro-environment.
So what's next for this plan?
Well, the next thing is it's going to a expert panel who is going to come back. The government expects that panel to come back with recommendations by the end of the year, so it's a very short time frame. From then, the government will then make decisions based on their advice and then set people off, the Parliamentary Council office to write the legislation, and it expects it to be law before the next election.
Negligent retention is at the heart of this week's explosive toil and trouble case. Stick around for the detail.
A company has had to pay significant compensation to 2 former employees following an assault that led to their resignations. The names of all the parties have been kept confidential by the Employment Relations Authority. The husband and wife who brought the case of constructive dismissal worked as a farmhand and station cook respectively, and both resigned after the husband was assaulted by another employee at work. They both lived on the property due to the nature of their work. They claimed compensation, lost wages and penalties for breaches of good faith, saying their resignations should be treated as constructive dismissals due to the way their employer handled the workplace assault. It raises the issue of negligent retention. And with me now to discuss the ERA case is Daniel Erickson, a partner with Tompkins Waite. Welcome, Daniel.
Good morning.
So what do you see as the key issue in this case?
Well, really the key issue here was the employer's response to the assault that occurred. There was no dispute that the husband was assaulted on site on the farm in the course of his duties. The employee that was the perpetrator of the assault, in fact, told the employer before the victim did, and immediately handed in his resignation. At that point, the employer really didn't take any further action because the matter was to be resolved by the perpetrator leaving the farm. However, what subsequently happened is there was a change of circumstance, and it's not really clear from the determination what that was, but there was an agreement between the employer and the perpetrator of the assault that they could stay on the farm for a longer period of time. I think the key issue was that when that occurred, there was an absence of communication with the victim and the wife, who were also both employees. And so when they became aware that the perpetrator of the assault was likely to be on the farm for longer than they had anticipated, and it appears there was no certainty as to when they were going to leave. At that point, the husband and wife felt unsafe. They felt like their employer wasn't taking appropriate steps to protect them, and that's when they tendered their resignation.
This case raises the issue of negligent retention. Can you describe for us what that is?
Well, essentially, the perpetrator employee was retained in the sense that they were still employed for longer than expected, and they remained on site. Now, again, it appears from the determination that the perpetrator employee was going to leave at some point, but for whatever reason was left on for longer. Now, at that point, where the employer was negligent was it failed to take any further steps at that point to re-engage with the victim and the wife. And so that's where I guess they fell short of their legal obligations.
It was a fairly brutal assault. The station hand was punched in the head and kicked off his quad bike, and several more blows to his head while on the ground. Now, the employer claimed they couldn't be expected to take more action when they didn't know the full picture, which included a verbal altercation the day before the assault. Do you think that's fair that they didn't know about, they couldn't take action on?
Having become aware of that issue, I mean, what the employer would typically be expected to do is investigate the circumstances of the assault. And that may bring out, the background as to this verbal altercation the day before. Now, the employer didn't investigate because the perpetrator employee tendered their resignation. And that's probably fair at that point because the situation was going to be resolved by that employee leaving. However, once that time frame was extended, then arguably at that point the employer's obligation kicked in to actually investigate the assault and the circumstances and do more at that point.
Do you think that the husband and wife contributed at all to the situation by not being communicative as they could be, which is what the employer alleged?
I don't think so. I mean, it's difficult to say based on what's recorded in the determination. It does appear that they obviously raised their concerns about the assault immediately. They shared the impact on them in terms of feeling unsafe, etc. So I think it would probably be a bit harsh to say that those two employees had fallen short.
What do you think the company should have done from a health and safety perspective?
Once it became apparent that the employee who perpetrated the assault was going to stay on site for longer, it should have been more communicative with the other two employees and shared that information with them and sought their views as to, the impact it would have on them. Depending on the time frame for how long that other employee was going to stay on, then arguably, the obligation to actually do a proper investigation would have kicked in, and that would bring with it whether or not the employee who was the perpetrator of the assault should be suspended, pending the outcome of that investigation.
Because he was told to sort of basically stay away from them, wasn't it?
He was, yeah. And that possibly could have been extended, but I think where the employer fell short is it's agreed with the perpetrator that they can stay on for longer without seeking any input from the other two employees who were affected. And I think that's the main failing there, is that absence of consultation and communication at that point.
And just on the compensation side, the total the company had to pay was $75,000, of which $8,000 goes to the Crown and penalties, plus costs. How does that rate in terms of, costs awarded?
I think the levels of compensation that were awarded, there was $20,000 awarded to the husband who was the victim of the assault and $18,000 to the wife. That's really that's about mid-range of compensation awards in the Employment Relations Authority. There's an issue here with the ACC legislation that the authority couldn't actually award any remedies for the assault itself, because that's all covered by ACC. So the compensation awarded to the husband who was the victim of the assault really relates to the harm caused to him by the employer's actions, that failure to consult, and then the loss of the job rather than the assault itself.
But obviously it ended up being a lot more costly than it needed to be for the employer if they'd handled it right.
Yeah, absolutely. I think if they'd done that step of consultation with the two employees and being more communicative at that point, I think it really would have put itself in a much better position.
The world has avoided a hard economic landing as central banks start to trim interest rates. For more detail, I speak with two economists at HSBC. First to you, Fred, how would you describe the health of the global economy at the moment?
It's still relatively robust, actually. If you look at the high-frequency indicators, we continue to see very strong global trade, for example. And even in the US, where there's been some concern lately about the potential of a recession, really everything points to a soft landing. Consumer spending still reasonably robust. Now, the Federal Reserve, of course, easing interest rates lately, and that was really to buy some insurance against a harder lending. But things are still ticking along currently. And of course, when we look at mainland China, there's still growth, but things are easing at the margin. That's, of course, raised concerns that we're going to see a further deceleration in mainland China, which is still a very important market for many economies in the world.
Well, let's focus in on the United States. What are some of the uncertainties as we head into Christmas?
Well, of course, the election itself creates a lot of uncertainty, and that also has implications for fiscal policy because the election will determine which party controls both the Congress as well as the presidency, and the two need to be aligned. The parties need to be aligned in order to deliver a supportive fiscal package for the next year. And so the election outcome in itself is important to gauge the outlook for growth next year and how much fiscal support the U.S. economy really can enjoy.
What about China?
Now, in China, we see continued headwinds from the property market, and it's hard to overstate the importance of property for the wider economy. For example, weakening property prices are pushing down on consumption. So the trick is really to stabilize the housing market. And the government has, of course, rolled out a lot of measures to try to stabilize demand for property. And we do hope that this will get traction over the coming year so that we are hopefully further towards the recovery in China in the property market, and that should ultimately help stabilize the broader economy as well.
Are you getting some positive signals about the outlook for their economy, the measures the government is taking?
Well, these measures will take some time to really gain traction. We still have quite a bit of oversupply in property, so it will take time. But you see the first signs of the government kind of stepping up its policy response. We might even see towards year end further stimulus measures just to put a floor under economic growth. And there are still bright spots. Manufacturing investments very strong. Exports are very strong in China. And in some pockets, even services demand is still relatively robust.
More broadly, do you think the rate hiking cycle globally is over?
Globally, yes, certainly it's over. Most central banks are poised to ease monetary policy. Now, in Asia in particular, we're watching very closely the Bank of Japan, which is a central bank that will likely move in the other direction and actually tighten policy of the coming year. But even they will move very, very gradually because inflation is on the way down in most economies across the world, helped by cheaper oil prices of late, but also by cheaper manufacturing goods prices, and that's helping to disinflate most economies in the world, opening up that room for central banks to add a bit of support to economic growth.
Paul Bloxham, what about the RBA?
Well, the RBA does seem to be in a different spot, actually. If you look at the global picture at the moment, inflation is coming down quite slowly in Australia. It's still well above the RBA's target, and it's sitting just under 4% still, and they target 2.5%. This is not perhaps that surprising. I mean, we've had in mind, actually, that inflation would prove to be a bit stickier in Australia, and I guess there are some differences in terms of looking at where Australia's at. So the first one that we've been pointing out is the RBA took a different approach in terms of how it managed the inflation challenge. It lifted interest rates by less than a lot of other central banks, including the Federal Reserve and including the RBNZ. They lifted rates by a lot less. And so the economy hasn't slowed down quite as much as you've seen in particularly in New Zealand. And then on the sort of other side of the equation, the supply side of the economy and productivity has been particularly weak in Australia. So that combination of things has meant that inflation is coming down quite slowly. It's still above where it needs to be. And despite the fact that we've seen the Federal Reserve cutting rates, most of the G10 central banks now in an easing phase, we don't think the RBA is going to be in that position for lowering interest rates for some time yet. We don't think the RBA will be cutting rates until probably around about the second quarter or the middle of 2025.
So is the RBA's approach working?
Well, they're taking a very gradual approach to getting inflation down. I guess the way I've been describing it is that they've taken a very patient approach. They've said, well, we want to try and stay as close to full employment as we possibly can and still get inflation down. So we're not going to slow the economy as much. The unemployment rate's going to drift up more slowly, and inflation's going to take longer to get back to the RBA's target. So this has been the approach they've taken. It's been their stated preference to prioritise staying close to full employment while getting inflation down. So the fact that it's coming down more gradually is kind of in line with the plan. So it's a little early days to know whether it's actually still going to work and whether it will be successful. But I think for the moment, what it tells us is the RBA is going to be likely to be one of the last central banks, I think, to be cutting interest rates across the developed world.
And unemployment holding up reasonably well, 4.2%?
Well, that's right. So the labour market is one part of the story. And as I said, it's partly because the RBA has taken an approach of not lifting rates as much as others. But it's also another factor as well. And that is, as I said a little while ago, I said, the RBA has taken a patient approach to trying to get inflation down. Well, they are very patient. But the fiscal policymakers have proving to be a little less patient. And so we're starting to see governments that are taking a bit more action and they've been delivering a little bit more growth and a little bit more public demand. And that itself is creating jobs, which is supporting jobs growth and is part of the reason why the unemployment rate has only drifted up very, very slowly. It's lifted from 3.5% to 4.2%, and I'd still say that is very close to what you'd still call full employment in Australia.
What do you think, Fred, about the rhetoric from the likes of Jerome Powell, not committing to a cutting path per se, but saying it's data dependent?
Well, because it really is data dependent. Yes, there are some indicators that flash warning signals about a sharply decelerating U.S. economy. We have seen, for example, a weakening of the labor market. But there are also other indicators which suggest there's still a lot of momentum left. For example, retail sales recently have shown quite a bit of resilience. And so it's not at all clear that the U.S. really is headed for a recession. And so the Fed bought itself insurance by really delivering a fairly large rate cut. But that, of course, doesn't mean that we're headed towards a territory where the Fed will need to add many more cuts to ensure against a recession. So I think it's right to be cautious here about this view that we're basically in dire need of aggressive easing by the Fed.
Paul, do you think Reserve Bank Governor Adrian Orr will be aggressive in the coming months, 50 basis points?
Well, it's really interesting, actually. When we've talked about Australia, and really there's quite a lot of divergence across the Tasman. We've been sort of talking about trans-Tasman divergence because the RBNZ did take a different approach to the RBA. They lifted interest rates earlier, they lifted them more substantially, and the aim there was to get inflation to come down faster, accepting that obviously it would push the economy into a bigger downturn, and that's precisely where you're at. The economy hasn't really grown for the past 7 quarters. In fact, the GDP numbers we got recently told us that it's contracting at the moment, and you're actually a slightly smaller economy than you were 7 quarters ago. So the approach was very different, to try to get inflation down faster, to weaken demand to make that happen. And inflation's come down. It's come down in a way that has allowed the RBNZ to already start taking action. They cut rates back in August. And we think that now you are on an easing phase. You are going to see a sequence of rate cuts coming through from the RBNZ over coming quarters. And that's going to help to start to reinflate, to support the economy. Now that you're sort of past the worst of the inflation challenge, the central bank can start to focus a bit more on growth, much like we've seen in a lot of the other G10 countries that we talked about, in the US in particular.
So do you think 50 in October?
I think that they're going to cut again in October. Yeah, I think that we're going to get a couple more cuts this year, and then we're going to get a sequence of cuts that come through next year. I mean, our working assumption is that the cash rate gets down to 3.75% by the end of 2025. So, that would give you, a sequence of cuts are yet to come through, and you're in a position where that can happen because the disinflation has come down, and that's setting you up for the next growth story. So the focus now, really, although monetary policy always gets a lot of attention, but the focus really needs to be on what are the next growth drivers likely to be. How can you best set the other policies in the economy for taking best advantage of those growth drivers?
So those growth drivers, what are you thinking? Are we going to rely on migration again?
Well, a lot of what we've been talking about, Fred and I, as we've been travelling this week, is the idea that, of course, both the Australian and the New Zealand economies are highly dependent on Asia as a growth engine, and that Asia growth engine is still very, very prominent. Asia is the fastest growing region on the planet, and although China's slowing down, as Fred's already described, there are a lot of other countries in Asia that are growing quite quickly, and so in particular, Australia and New Zealand don't have as big a ties to those economies in South Asia, the India plus the ASEAN countries, but these are fast-growing economies with rising middle classes, with lots of growth opportunities. So I guess the primary thing we're sort of emphasising is that Asia is going to continue to be the growth opportunity for Australia and New Zealand. We need to do our best to set ourselves up to be able to best take advantage of those opportunities that are there.
And finally, Kiwi cleantechs made the list this year for the top 25 Asia-Pacific startups likely to make an impact over the next 5 years. Fiona Rotherham has more.
New Zealand could be a world leader in the burgeoning cleantech sector, but what policy changes are needed to help make that happen? Fiona Rotherham talked to the CEOs of 3 rising cleantech stars about what changes they'd like to see to boost the industry and their own company's global progress. So Fiona, who did you talk to and why them?
So I chose 3 companies that were on the list of cleantech groups, 25 most promising startups in Asia Pacific that are most likely to have significant impact in the next, 5 years or so. So those companies were Geo40 and its CEO John Worth, Aspiring Materials and Mark Chatterton, the CEO, and Jonathan Ring, who's the founder of Zincovery. Now all 3 of those companies are raising investment or have just raised money. They're all on the cusp of either doing pilot plants or demo plants, so they've proved their technology in the lab, well proved it, but they're now trying to scale up. And so they've got a really good picture of where things are at in terms of both raising money and scaling.
What sort of changes did they want to see happen?
Well, the biggest bugbear for the industry is attracting investment, and all 3 of them talked about that. I mean, it's one of the things that came out in the May report on the cleantech sector that was done by the Cleantech Mission. So Geo40 is right on the cusp of breaking into the sustainable lithium extraction market in North America. It's working with oil and gas producers there. And it was the first to get colloidal silica out of geothermal fluids here in New Zealand. It's got a plant at the Contact Energy Ohaki site. So it's trying to license that technology, but it's also moved into lithium because it sees quite a big market there. It's managed to get offshore investors. So it's got Tembo Capital, it's got Vision Blue out of the UK, and so it's sort of well on the way. And the money it got in from both those investors last year and the year before have options to put in more. So he's trying to raise money for this demo plant. He's really hopeful he can get those options. It also had a lot of money from the Provincial Growth Fund to build its original plant and has had subsequent money from Kānoa. So it's had money that way, but he's really concerned for the rest of the industry, saying others haven't been given that leg up. And he'd really like to see, one of these funds ring-fence money for the cleantech sector. He also thinks corporates don't really lean in here. They don't, provide this sort of technology support or other support that you see in sort of like Scandinavian countries. He calls them... Kiwi corporates has been quite cynical. He says they're all saying what's in it for us rather than saying what can be in it for New Zealand Inc.
And what about the other 2? Did they want to see similar or different things?
Yeah, so Mark Chatterton's with Aspiring Materials. So Aspiring have come up with a really novel technology that takes rocks with the mineral olivine, and they go through this chemical process and turn out a material that actually reduces carbon dioxide emissions, so either in the atmosphere or at the point of source, such as industrial smokestacks. And then it basically develops a whole lot of low emission products out of that. So it's really clever technology. It's trying to raise $7 million US at the moment, and it's a really tough environment to be doing that in. And Chatterton wants more government support, not just funding and not just non-dilutive funding through grants, but he wants to see things like they've got in the US, there's federal and state level financial incentives, carbon pricing mechanisms that, to reduce greenhouse gas emissions. They're quite substantial compared to what you can get in New Zealand. And, he cites example, there's a recent deal between Google and, a Tennessee startup over there. They're going to get US $100 per tonne, which just makes all the difference between investing in the company and attracting, the thing is that sort of money then brings in other investors. And it's just really hard in New Zealand because without that, lack of support, it doesn't happen. And he thinks the New Zealand Green Investment Finance Fund is just too risk averse. And so he's agreeing with Worth around having some ring-fence money just for cleantech sector. If you say you support the sector, put money behind it and that sort of thing. And then finally, Jonathan Ring, Zincovery's just raised $12 million, but it was a really long, drawn-out process and a hard process. He got more than they wanted in the end, but it was pretty hard to do. So they've got a novel way of recycling zinc that's a lot more cost-effective and uses less energy. And they're about to build a pilot plant here in New Zealand. He thinks that the government should be picking winners, so he doesn't want to see the government invest directly. He thinks that there should be more money for things like New Zealand Growth Capital Partners' Elevate Fund of Funds model, where that money goes into VC partners who then will commit to putting more on themselves. It has to be matched funding, and that way they've got more money to deploy, and Kiwi companies end up getting more money. So those are some of the ideas they've got.
Do the companies have any concerns about tax incentives?
Well, this was Jonathan Ring in particular. There's two types of tax incentives out there. There's the research and development tax incentive, which is 15% of what your R&D spend annually gets returned to you. But the other one is more aimed at startups because they're still in loss mode, so they can get refunded their tax losses. But the catch with that is that if the company goes under, those directors are liable for what's been paid out. And so it makes, as Jonathan Ring says, I'm prepared to do that as founder, but are the other directors on my board? No. So what he's doing is simply putting that money in the bank and spending the interest on it, which is not what it's intended. It was meant to, help these companies grow, but he said he just can't take that risk. So he's just simply doing it that way, and it's pretty crazy to have that. So he'd like to see change in that area.
Thanks again for joining us. Our news team is back from 5 a.m. tomorrow with the latest business news you can use on mbr.co.nz. See you next week.